So good afternoon, everybody, and welcome to Marcellus's webinar with Anupam Gupta. And we are here to launch, virtually launch Anupam's new book, The Wisest. It's a book where I had the privilege of writing the foreword. The subtitle of the book, Be Your Own Financial Planner, tells you what the book is about. And over the next hour, we've got the privilege of discussing with Anupam what is a really fluidly written book on how you, I, and millions of people like us can make the most of our savings. We can avoid the common mistakes that most affluent Indians make. And Anupam's written a book about the best financial advisors, the best financial planners in the country, who can help you and me get the most out of our money. So welcome, Anupam. Welcome to our webinar on your latest book.
Thank you for having me, Saurabh. It's an incredible honor. I've had you on my podcast, so it's a really, it's for me, it's a really big thing because I know the distance that Marcellus has traveled in the last 4 years. And of course, we worked together at Ambit. And so it's really good to be here. Thank you so much. Really. Thank you for having me here.
Our privilege. So folks, as usual, Salil and I will do the honors. I will have a Q&A with Anupam for 20-25 minutes. And then in the remaining part of the hour, we'll take as many of your questions as we have and we'll put them to Anupam. So keep firing those questions into the Q&A box and we'll take as many as we can by 7 p.m. On this Janmashtami Friday in Mumbai. So for those who haven't met Anupam before on our webinars, for those who haven't encountered Anupam's podcast before, let me do a little bit of a semi-formal introduction. Anupam Gupta is a chartered accountant, but just as importantly, he's the award-winning podcast host of Paisa Vaisa, I think rated by across Asia as one of the best personal finance podcasts. Anupam and I had the good fortune of working together on the Victory Project, which has become a bestseller for Penguin. Before Anupam became a podcaster and a best-selling author, he worked for over 2 decades as an investment research analyst and as a thematic research consultant in the institutional equities world. He worked with top-class brokerages like CLSA, Barclays, Ambit Capital, HDFC Securities. And whilst I have had the good fortune of working with Anupam on a book, in fact, Anupam and I are working on another book at the moment, I would safely say, and I'll say with a lot of confidence, this man is one of the best writers on finance and financial services in India. So it's a real privilege to host him. And I hope for many, many years, I get the privilege of working with Anupam Gupta.
Thanks, Saurabh.
So Anupam, let's begin with the sort of genesis of this book, of the genesis of the Wisest, right? What led you to write a book on financial planners, financial advisors? Were there certain things you saw in our country's landscape which told you that this is a good idea?
Yeah, Saurabh, this all started with my podcast. My podcast started in 2017. And when we started, me and the studio, that is, we started on a lark. We just, the studio approached me and said that, let's do a podcast and let's do it on personal finance. And I said, yeah, sure. Because I was very confident that the podcast would wind up in 3 months. Who's interested in personal finance at that time? 2017 was very, very different. Very different now when you look back at it 5 years ago. But we persevered, we kept at it. We got a lot of guests. A lot of people came into the podcast. And as the podcast progressed, when I used to interact with the guests, when I got listener queries, when I used to talk with people in real life, the same questions would just come up over and over again. That what should I do? Where do I start? Where do I know more about money? Should I invest directly in stocks? Should I invest directly in mutual funds? I go to meet friends who are not part of the market, who are not part of personal finance. They see the stock market going up and the only question is what stocks to buy, which PMS to buy. I have 25 lakhs, I have 50 lakhs and I want to. And there are so many misconceptions, the fact that, for example, that if I'm putting 50 lakhs into a PMS, I therefore deserve more returns than a mutual fund. So the approach that a lot of people had towards their money was limited, still is, I feel, that for them, money is, their investments need to get a great return. And what I was trying to say is that, listen, look at yourself, whatever, 25, 30, 40 years from now, you're 65, you're retired, you're 70, and you're chilling out somewhere on a beach with your family, you're having a really good time. What's more important to you? That you reached your corpus or that you beat the best fund manager in the world? So what are your priorities out here? And are you honestly doing, would that give you more satisfaction that I beat Warren Buffett? How does that even matter? And, where is the goal-based planning out here? That are you, keeping some money here, some money there, and that is at a goal level. Where are your finances right now? And the same answer, Saurabh. I've got so much in a real estate project. I've got so much in gold. I am entering the stock market with a small amount, because I want to double my money. So all of these, I just thought that since I don't have any credentials, God knows that I can't pass that SEBI exam to become an RIA. I thought, let me just talk to the best in the field out there. And I had a methodology for choosing these people. Let's get their point of view and let me just talk about it. That's why the book's on.
So before we come on to your methodology for choosing India's best financial planners, and that's a fascinating part of your book, how you went about identifying out of India's 1,200 SEBI registered investment advisors, how you went about identifying the best of the best. But before we come on to that, what are the common mistakes that affluent Indians make? You already highlighted a couple. People think they're in some sort of game where they have to outcompete Warren Buffett on this alpha nonsense that we keep hearing about. Second thing you alluded to is real estate ka disaster, right? What else? What else have you seen as the most common mistakes that Indian people make on savings?
So, this thing with gold, it probably has to do with a certain age profile of people, who are my age, 50s or late 40s, and they still feel gold is quote unquote safe. It is liquid. And now there are so many options to invest in gold. There is this, there are sovereign gold bond, there is this, and there is that. And I was like, have you actually looked at gold long term? The returns are off. Equities will probably give you if not the same, then at least slightly better returns than gold. Sure, there is some amount of volatility, but you're at least getting a more transparent way of investing in the market. So that was one. Real estate is a big one, Saurabh. People, I can understand that they want to buy their own home, and for that they're willing to dedicate a large part of their funds to, towards buying their own house. But this investment thing never made sense to me. You're buying an illiquid, opaque asset, okay, or an investment. Actually, people actually, if you ask me, they don't even know the difference between an asset and an investment. It's like, why, and all investments are assets, but all assets aren't investments. So if you're buying real estate as an investment, it means you're doing it for a rate of return, okay, and you're doing it for some returns in a year. But what returns are you getting? You're getting 2% rental yields for an asset which is 7% interest, and that absolutely and completely doesn't make sense. What is the pushback? Well, it's a real asset that I can see with my own eyes. I was like, okay, so you can't see stocks, is it? No, we can't see stocks. They're in some demat. But okay, fine, if that, mentally, if that is there. So a lot of these mental hangups were there. So gold, real estate, then of course, debt mutual funds. My God, I mean, these people think that debt mutual funds are better than FDs, which might be true in a certain limited way of the argument, but the idea that a debt mutual fund is foolproof. I mean, you have to remind them that, listen, one of the biggest mutual funds schemes in India shut down. Would you want to freeze? Your access to your money is frozen at the time that you want it the most. How is that going to work out? If I remember correctly, back in 2008, 2009, when the global financial crisis happened, liquid funds broke the buck, not only in the US, but even in India. Now, in a debt fund, for your capital to go down is something apparently people didn't know. And you have to tell them that, listen, this is actually true. And then, when you talk to them about credit risk, duration, etc., I don't know. So, these were the 2 or 3 myths that were there. The biggest one, sort of, when it comes to equities, if you leave aside gold, real estate, and debt mutual funds, with equities, people are obsessed. Thanks to these WhatsApp groups and the market channels and social media, people posting screenshots that I made so much money in trading, I made so much money in investing, this is my portfolio. I was like, listen, honestly, other than an ego boost, what are you really getting out here? Like, equities is a 10-year, 15-year, 20-year game. And at best, your only chance is that you have a higher chance of not losing money if you stay for the long term. So these are the 4 or 5, 3 or 4 misconceptions that I thought that I should dispel with the book.
Fantastic. So, folks, I'll just reiterate the offer. Fire in as many questions as you can. We've got Anupam till 7 o'clock. Let's make the most of it. Put the questions in the Q&A box, and Salil will take as many of them as he can. So, Anupam, let's get on to the crux of the book. What for me made my Sunday afternoon, when I spent 2 hours on a Sunday afternoon, I thought I'll spend half an hour, fir kabhi aur padenge. But after half an hour, I was hooked, and I spent 2 hours reading the entire book. It's a super, super read. How did you go about identifying India's best financial planners. It's a Herculean task, 1200 financial planner, but more importantly, it's a qualitative comparison to kiya kaise aapne.
Yeah, Saurabh. I mean, there's one thing that I found out that these advisors are very busy people. Getting the time of day is difficult. Anyway, just to start on the basics, the first question was that how do you define one? Because the thing is that in India, advice is not regulated. So so what were my options? My options were mutual fund distributors, registered investment advisors, certified financial planners, and honestly freelancers. So the first question was define an advisor. So in that out of this huge, really big pool of free and paid advice, I said I will go with a registered investment advisor because these are controlled by SEBI. It's a regulated market. It's new. I will not look at mutual fund distributors, although a lot of them have done fantastic, a really great job in making people aware of mutual funds, but their product is limited towards mutual funds. So mutual funds are out. CFP is an international degree. Okay, a lot of people are also a lot of people in India also have the degree, but the veterans in the advisory space already have a CFP. Most of the people that I interviewed. So first is make it into focus narrowly on RIAs. Second layer, keep it only limited to metro cities. It's a voluntary book, Saurabh, and as you would know that no one writes a book to make money, right? So if my resources are limited and I need to focus only on a small set of people, I said I'll only have it in the 4 metro cities. Okay, so that's Bombay, Delhi, Chennai, and Calcutta. Thankfully, about 800 out of the 1,330 people, 330 registered RIAs were part of that. So I already have a fairly large sample space. And after that, then it became a little bit more subjective. I just put in one layer that you should be at least 7 years. You should be practicing as an RIA for 7 years minimum. That's because SEBI's guidelines came into existence only in 2018 2013, and this book was written in 2021. So I said, let me at least have the 7-year minimum. So those are the 3 or 4 criteria that I had. The older that you are, the better you are in a business, and that's it. Sort of after that, I was very lucky to do this in association with Deepthi Bhaskaran, who was introduced me by Monica Halan. And Deepthi has a lot of experience on Mint, because she was part of the personal finance team at Mint, the newspaper, and Mint, as you know, has a really good personal finance product. So she so she made a list of comprehensive questionnaires, because when I applied these filters, my final shortlist came to about, I would say, about 20 to 25 RIAs. So next was, how do I choose the last lot from this? So we had a questionnaire to all of them, and that questionnaire was very subjective. How do you shortlist your clients, etc., etc. What is the onboarding process and all? And of course, we focused only on the RIAs who did holistic, goal-based financial planning for a fee, because a lot of RIAs, I believe that you also, Marcellus also has an RIA license, that we excluded everybody who was doing only equity advisory. So that honestly left us with a really small bunch of people, a lot of whom were more than 7 years old. So that was the process, broadly. A lot of weightage on experience, a lot of weightage on the calls that we made to the industry to ask people that, have you heard of them? What is their reputation? So a lot of softer factors and this age-based, experience-based bigger factor.
Right. So folks, this part of the book, right, where Anupam lays out at the outset how he went about identifying India's best financial planners, I've never seen anything like it. And the result is, he's identified some people we knew, some people in the book we knew about, some of them are actually our clients. But there are advisors who I hadn't read about, I hadn't heard about. So for example, Harsh Rungta, I'd sort of read his columns in the newspaper from time to time, but didn't interview that Anupam has done with Harsh Rungta Sab, which is I think itself worth the cover price of the book. So Anupam, let's move forward one step. The subtitle of your book, Wisest, be your own financial planner, right? So how can the people watching this webinar, how can they become their own financial?
Okay, so Saurabh, there are 2 parts. So I'll keep this answer in about 2 or 3 parts. The first is the DIY part, which I call, people who want to do this on their own. And the book has spent a lot of time talking about how to start answering that question, where do I learn more about money? So I've given recommendations of books. There is, pretty much all the books that you've written. There is Monica Hallan's Let's Talk Money. There is, of course, Morgan Housel's Psychology of Money, Wealth of Common Sense, Deepak Sharma. So there are a lot of. So the first, like we wrote in the Victory Project, the first is forming that very strong base. Now, I don't know how many people will actually believe that, because what I've seen is people just love to do this short form, bite-sized way of learning things. यार मुझे please WhatsApp पे भेजो, Instagram reel देखना है, ये करना है. I'm like, listen, maybe it's my age, maybe I'm old school, but I firmly believe that you need to read books to have that foundation. All of that social media stuff can follow later, but at least have a strong foundation to begin. And it's a book. My book is less than 150 pages, Saurabh. I'm honestly, if people can spend the 4.5 hours a day, Saurabh, I don't know if you know that number, is the time that people spend on their mobile phone. 4.5 hours. And I'm just saying, listen, just take half an hour every day and read these books. Anyway, so you make the foundations by reading these books. These are trusted people. These are people who lay down their reputations, their livelihood on what they do. I mean, you've put everything behind what you do in Marcellus. Monica Hallan is someone who's, I've personally called her the gold standard in personal finance. Same thing for Morgan Housel. Same thing for Ben Carlson. So these are people with good reputation. Their books are accessible. They're easy to understand. Build that. Then if you want what I call the daily updates or the weekly updates, track what these people are saying. So if you've read Saurabh's books, then please subscribe to the Marcellus newsletter. If you have read Monica Hallan's book, sure, if you want to be on social media, please follow her. She always writes very interesting posts on her blog. So that's how you build your knowledge. Okay. And you need to learn some concepts out there: risk, return, liquidity, taxation, stuff like that. So once you feel confident enough of that, then of course, then there is the whole thing about finally investing your money. That I'm going to say is a personal thing. So I will not talk about that part, but I think a goal-based approach makes much better sense than just figuring out where to invest your money. I've had so many people come to me saying that, yeah, what's the best mutual fund? And I'm like, have you at least taken health insurance? No, but I don't need health insurance. My company has insurance. I'm like, come on, yaar. Where are you getting this? Where are you getting this from? You need to have your own basic health insurance. Or even basic stuff about credit card, how people max out their stuff, this whole BNPL thing that's happening. So personal finance is a lot more than just stock market. Okay. So, that's the paid part. So that's part number one. Part number two is for people who are probably in their late 30s or 40s and who, honestly, as we wrote again in the Victory Project, you should be focusing on what you do well. You have a full-time job, you've got a family, you've got responsibility. So please focus on that. Why are you on WhatsApp trying to track what ITC's price is today? Okay. So go to an RI. I've given you 6 RIs in this book. Understand their backgrounds. A lot of my book, a lot of the interviews are about the personal journeys of all these people. So when you choose an RIA, it's like you're choosing your doctor. You don't, you need to have a certain level of comfort with these people. So read the interviews, probably if you want to choose from them. If you don't want to choose from them, I've given an entire questionnaire on how to choose an advisor. Find out more about him. Where does he get his money from? What is the onboarding process like, etc., etc., etc. And most of these RIAs sort of have a free, they'll give you one session for free. You can sit and talk with them, understand if it's suited to your needs. So that's part 2. Part 3 has to do with, making your own financial plan. And this is for the people in the first category, the DIY people who obviously, will not have the same corpus that you would need to go to an RIA, but that doesn't mean you shouldn't plan for your finances, right? So sit, open an Excel file, make a P&L, make a balance sheet, and write your goals. That's it. That's all. That's really all that it needs. You do not need to put in Reliance, Bajaj Finance, ITC out there. Just have a broad top-down kind of a thing. And I think that should start you off really.
So until I read the Wisest, I used to think BNPL is the name of a French bank. And I realized that I'm clearly behind the times. BNPL is also the name of a French bank, but it also means buy now, pay later. Why anybody would want to do that? We will discuss it in a future webinar. So one of the most interesting things about living in India in the last 5, 6, 7 years is that the kind of rapid financialization of savings at a rate, honestly, I didn't anticipate 5-6 years ago. I didn't anticipate that on a Friday evening, we will have 150 aficionados listening to a personal finance webinar. I didn't anticipate that Marcellus would pull in the best part of $2 billion in less than 4 years, right? This whole drive towards financialization from these legendary financial planners, you would have had a different perspective on it, right? These financial planners, I read in the book, several of these people started business 20 years ago. What are they saying? What do these financial planners believe has been the catalyst for rapid financialization away from real estate, away from gold into financial assets?
It's very interesting, sort of. One, I think the basic building block across all of this, what the 6 RIs told me, is awareness. Awareness on 2-3 things. One is the option of having a financial option as compared to a physical option, which is that you don't need to put all your money into real estate. There is a stock market and there is a sensible way of investing in that. So one is that. The second awareness is awareness for the next generation. So a lot of the 40-50-year-olds, for example, who know that they're going to retire in the next 20, 10-20 years, they know that the aspirations for their children will require a very different type of financing. You cannot have your kid go abroad for education by investing your money into a real estate house or a whatever. You'll probably get 7-8% out there, but you need to have a much more diligent approach towards funding that. In the US, you would know, Saurabh, that a college fund is a very, very common thing across households out there. In India, only now is that whole college fund things coming in, and people actually thinking that they can invest into it. I'm doing it myself, that put in your money to an index fund, commit to maybe a 10-15 year time frame, and even if you get 10% per year, if you're increasing your contribution, your kid has a very good, you have a very good chance of hitting that corpus in that time. So awareness number one, you don't have to put your money in real estate. Awareness number two, there is a systematic, diligent way of achieving your goals, provided that, and that's the third awareness, planning for your goals. Previously, there was no plan, sort of. You used to just work. You start, you're 25 and boom, your parents say buy a house. In 10 years, boom, you have to get married. Then you get kids and this. There was no planning out there. Now, at least you can say, and these are, by the way, these are normal people I'm talking about. I'm not even talking about the HNIs. HNIs so is in a different space only altogether. There you've got sudden money coming in. Someone who sold off his company and he has a pot of money. In the past, what would that person do? He'd probably buy some, 5 BHK in some unknown place, and that's it. He's done. Now there are options for him because he's more aware. So I think the imagination and the awareness is the one single factor that's driving in money from the customer side. Now, from the regulator side also, a lot of things have happened. So, you would know that these fintech companies, whatever our opinion might be about them, but all the free money that came in from the US, that has gone and just pumped into a lot of these startups. Some of them have at least, done a very good job of creating a reasonably large user base, whether it's the Paytms or the ClearTax. ClearTax has, I think, a 5 or 10% market share of all income tax returns filed in India.
Wow.
That's a huge number, and for them to create that, at least I would think it's commendable. They've been on my podcast. I think that the overall number is 6 crore returns are filed every year, and they have about a 6 million, user base. So I think that's commendable. And you would recall 10 years ago how painful filing your tax return was. So this entire mix of regulation, fintech, and a smooth experience is what has driven this, this entire financialization boom.
Interesting. So there's lots of people who will watch this webinar and they'll say, "Chalo, kitab to padhte hain, we will read the Wisest Owl." But they'll also say, "I want to get started on my financial planning ASAP. Mere ko kuch karna hai this weekend. I want to get on with it." If someone wants to begin their financial planning journey, what are the best online resources, Anupam, for such people?
So I think you can get templates for financial plans pretty much anywhere. I think that's the basic start that you can do is you can just download one of these templates. If you want, you can do it yourself into an Excel file. I think first you just need to spend some time in understanding your income, your expenses, and your savings, and therefore what you should invest in. Now, that's the first part. Then, of course, it comes the slightly trickier part of choosing certain financial products, provided that you've understood that do I, for example, have enough insurance? Okay. B, how many credit cards do I have? What kind of limit is there, etc., etc. So once you've put these pieces into place, into either an Excel file or a notebook or whatever, then comes the next step. And honestly, after that, I've already spoken about how you need to understand some very, very basic stuff. How do stock markets work? Okay. Once you've understood that, commit to an SIP. Okay. And again, how much do you commit? And where do you put that money in? So these are all questions that the individuals will have to answer themselves. For me, Saurabh, what has worked really well, and this is what I've told a lot of people, is figure out what are your savings are. Okay. And have a plan as to what you want to commit. So let's say that you're someone who earns 50,000 a month and you spend 30,000 for whatever rent, food, and you've got 20,000 left. Okay. I would say that at least take a part of that, put it into an emergency corpus. The first most basic thing is to build an emergency corpus that is accessible to you. Okay. Now you could put that in in an FD with an SBI, which is pretty much sovereign guarantee, or whatever you choose to do. I would not want to go into advice for financial products. And then when you're left with the last bit, that's when you decide on the asset allocation part. And that's again something that, is individual to a lot of people. Within that, after that comes the decision on products, which is within equity. What do you do? For someone who's starting off, Saurabh, even you would agree, you've written about this also, about how the NPS is a fantastic low cost solution for a lot of people.
I'm a big NPS user myself. Every month I invest in the NPS alongside Marcellus's products.
So do I, Saurabh. And it's such a beautiful, low cost, easy to understand product. And you're committed to it over the long term. It gives you an annuity at the end. So that's one. Index funds are again a great place. So I think sort of these are the few places which can start you off when you're going to spend time on that weekend. After that, honestly, then comes the tough part of staying in touch, reviewing your portfolio, I would say every month or every 3 months, and seeing where you are. Once you've got your goal sorted, then your investment values will help you to track where you are on that cycle and whether you need to make some small change. So I think that should hopefully help people to start off.
So folks, keep punching those questions into the Q&A box. There's already a lot of questions there. So Salil, over to you, so that we can get Anupam to help our audience out.
Sure, Saurabh. Anupam, first of all, thank you for writing such a relevant and such an important book. So let's kick off, Anupam. You mentioned this in the first part, but maybe we can just try and put these together. So this question comes from a couple of people, Lalit, Soni, and Divyansh Verma. So they're asking, kind of young professional just started earning, right? And Lalit is saying that he wants to actually put into an emergency fund. Question is, how much should an emergency fund be? Are there any thumb rules, right? And would an emergency fund be the same as, say, buying term insurance, or do you have to even go for term insurance? And then, what are the next steps?
Yeah, I've spent so all the RIAs that I've interviewed in the book, each and every one of them have said that an emergency corpus is a must. It is completely different from term insurance. An emergency corpus can be anywhere from 3 months to 6 months of your expenses. That is the first, it's a range. There's never going to be a precise number, that you should have 3 or 4 or 5 or 6 or 1 year, etc. I think COVID, layoffs, and a lot of uncertainty in the world has driven people towards this. I don't think 10 years ago there was even any conversation on emergency corpus. Now a lot of people are considering it. So first is, yes, you need one. It is different from term insurance. 2, how much is enough? The RIAs in my book have all spoken broadly of 6 months of expenditure. Okay, if that looks like a lot, then you could probably break down the expenditure into something that you consider to be essential, which you can't compromise on, stuff like rent and food. Now, maybe you don't want to buy the next iPhone, so then iPhone should not be part of emergency corpus for sure, but at least the basic living expenses for the next 6 months should be part of your emergency corpus, where again the opinion is divided widely. People think that debt mutual funds are a good place, something probably like a liquid fund. I have seen in my experience, and Saurabh also mentioned this, that we've had liquid funds shutting down, shuttering completely. My own preference, and where I park my own money, okay, and I say this as preference, not advice, is an FD. An FD, irrespective of what people say, and even the advisors, some of them are very anti-FD, is the only financial product in India that guarantees return on capital and return off capital. I don't know any other product in India that gives you that. And if you look at an SBI FD. An SBI FD is, come on, I mean, that's sovereign, right? So with a large reputed private bank, if you parked your money for a 3-month FD or a 6-month FD, I think that could be something that you want to consider. So I think that would be my answer, Salil.
It makes sense. Thanks, Anupam. The next question, and this is an interesting one, and this is from anonymous attendee, and I'm assuming that there's a clear reason why he's not given his name. So he's saying he's married. He got married recently. He and his wife together earn around 2 lakh rupees a month. They live in the NCR, and he says that family, friends, everybody's putting a lot of pressure on this couple to go and buy a house. And he thinks that buying a 1.5 crore house is pretty useless. Might as well pay and stay on rent. So real estate as an investment is something which you already made a mention of. But do you think the idea of buying a house to live in? How do you look at these two?
So again, when I look at the collective wisdom of the advisors that I've interviewed in the book, and they've dealt with this at length, because this is a question that I've asked each and every one of them. That what is this deal about rent versus buy? And all of them, Salil, they said it's not a financial decision. It's an emotional decision. Okay, so just leave all those, leave that Excel file. Just leave that Excel file and sit and think about how much you're willing to dedicate from your money towards an EMI. Okay, and of course to the down payment. Now all of us know that I think loan to value, Saurabh, are about 4 or 5 times, and I think you need to have 80%. You need to put 20% down. So for a 1 crore house, you're putting 20. Do you have 20 lakhs? And would putting 20 lakhs really break your finances? Okay, if it doesn't, consider. So there are the mathematical questions, and then there are the emotional questions. That why do you really need a house? Do you want to ground yourself in one place? Do you want to be there, stay there, have security, stability? So if you can answer the emotional questions and the mathematical questions, only when you tick all the boxes at the end, if it is safe enough for you, if you're not stretching yourself, if you know you're going to be there for the next 10, 20, 30, 40 years, and you're not going to ascribe a value to that house. Salil, that is one thing that I've seen so many people think, that my house is worth so much, and I think it's called the wealth effect or whatever, but at least for a house, I feel that a house that you have for yourself, its value should be zero. When you make your balance sheet, when you make whatever assessment of your finances, please ascribe a big fat zero to that, because that is, it's not something that you consider. So I think that if you move away from the rent, the rental yield versus interest rates, a house buying decision for your own self is an emotional decision and a mathematical decision. The maths is easy. The emotion, honestly, is for it's person to person. I would never ever advocate, or even the RIS for that example. Forget me. None of them, not one of them, have said that you should stretch yourself to buy a house. Please don't do that. Please go on rent. Do not stretch yourself for that. It's only when you reach a certain phase in your life where you feel that you want to buy it, go ahead and buy it.
Right. Great. Thanks, Anupam. Hope anonymous attendee, you have your answer there. Now, moving from young people, let's go on to this question, which has come from, I'm assuming, a senior citizen, and this is Mr. Narendra Shah, and he says that how should investing and planning for the same to be done by senior citizens? How do you differentiate between what a working guy should do and what a retired person should do?
Wonderful question. Actually, this is again, one of the big questions. I'm sure Saurabh also might have got this from a lot of people that he has met. But I think that planning post-retirement is a little bit tricky. You need to see what kind of corpus you have, and honestly, there's not much space, Salil. When you're at that age and at that stage of life, the opportunity to have recurring income is really less. So the advisors that I've met, and some of them have spoken about this at length, they basically talk about adjusting your expenses, adjusting your goals. And again, this is for people who have restrictions, because if you're 60, 65 years old, you need to plan for a 20 to 30 year. As there are some advisors who I met who even talk about 100-year lives nowadays. That might not be that rare going forward. So you need to plan for that long a runaway without any reliable, steady or recurring income at the level of, say, your salary. You'd probably have interest on retirement deposit, and India has a lot of these schemes out there which offer a reasonably good rate for senior citizens. You would be looking at provident fund. So with such a narrow space there, I think there are certain priorities that should be looked at first. Health, the biggest one. Okay, that's again, this again comes from the advisors that I've spoken to. Please ensure that you've got your health insurance sorted for the next 20 to 30 years. There are some insurance companies. I had Star Health on my podcast just last week. I mean, the episode is just out on Pesa Vesa, and Dr. S. Prakash. They have products that are womb to tomb. Now, I'm not endorsing them, but I'm just saying that when you go out looking for insurance at the age of 60, 65, your options are a little bit limited. So please have your health insurance in place. Please have your essential expenses in place, and then work backwards from your corpus. That if if you think that your expenses per month are whatever 50,000, that's about 6 lakhs in a year. So if you're looking at a 10% return on your corpus, you should have a corpus of 6 crores. So all these numbers are pretty simple to do on an Excel file. But there are certain priorities that you need to have at that age. And this is again the wisdom that I've got from the advisor that I'm sharing. I hope it is helpful for them.
Thank you again. Anupam, now there are a couple of questions on RIA. So one is on selection. So people want to know how large should a corpus be, or how large should your savings pot be before you actually consider engaging with RIAs.
Lovely, great question.
Yeah. So if you can answer this, and I'll follow up with.
So Salil, the thing is that the RIA model currently is, it's linked to AUM. Okay. At the same time, RIAs are flexible. Melvin Joseph, who's based in New Bombay, wonderful. He's one of those advisors who follows a fixed fee model. So whether you come to him with 10 lakhs or you come to him with 1 crore, he's going to charge you the same. And he's got a model of a flat. It's basically called a flat fee or a fixed fee. Almost all of these RIAs have a model that you can take a one-time charge, as in you come to them and whatever your corpus is, they don't care. They'll sit with you for whatever 1 hour, 2 hours, 3 hours, and give you a basic document. And for that, they'll charge you whatever money, whatever their fees are. They'll give you a plan that you can commit to. So these are situations where it doesn't matter what your corpus is. Okay, just reach out to them and talk to them. These are the human ones, and they can at least get you started. Now, after you have got the plan and you want to commit to it, that's your call. And then you can talk with the RI that if you want to continue this engagement over a period of time, what are the fees that you're willing to pay? All of this is SEBI regulated. There's very little space for the RI to do any mischief. SEBI is now very strict with all this. The second thing is robo advisories. There is Artha Yantra, I believe, which is Pune based. A few of them have opened up, which if you want to explore the robo model, you don't want a human being out there. Personally, I'm more comfortable with a human being, but then I'm 50 years old. A lot of the newer crowd, prefers this, the robo model. So a lot of robos are also out there. Honestly, I did not do any research on them. But one name that kept on coming a lot from a lot of people who I spoke to was Artha Yantra. They are Pune based, and there are a few others also. They offer a very simple robo-based model. You upload your details and all that, and they give you a plan. And then if you want to engage with them further, they have different levels of service for you. So human advisor, robo advisor, there's enough out there to choose from.
All right, great. In fact, the follow-up question was on fees, and question is that, in fact, a purpose of a book seems to have been achieved because this person read the book, contacted the RIA, spoke to them, but he was a little taken aback or maybe a little surprised by the fact that the RIA asked for a 1% fee. But you're saying this is a regulated number, so it's all right. If you see value, then you should go ahead and engage.
The percentage of AUM, now it's a bit of a tricky issue out here. It comes across as a large number for a lot of people, but anybody who's handling finances, if you see the value that these people put in, all of these RIAs have 15-20-year models. They've been doing this for the last 15-20 years. And the kind of value that they bring to the table is something that is different from person to person. Some people might find it too high. Some people, might think it's exorbitant. I'm not here to take a subjective call on that. I believe, like I said, that I think a few of them at least offer you that one-time planning charge. And again, like I said, if you think that those fees are too much, then there are robo advisors. There are people who will do it to you for a lower fee or a flat fee. Please feel free to explore them. But I think that the percentage of AUM is something that's regulated by SEBI. I've given an entire list of questions at the end of the book for people to actually ask the RI to get a level of comfort.
Perfect, right. So as long as there is a regulatory limit, people should be comfortable with that. Right. Now, Anupam, there are some questions on the goal-based, goal-focused financial planning, and so one interesting question is that education of children and retirement. Right. If I have already planned for those by investing in, say, mutual funds or some other assets, is there anything else left to do? Why should I then really think about financial planning? These are the two big life events, and they have been taken care of. Is this understanding correct, or there are some risks here?
I'm no one to decide the goals for the person, right? I mean, a lot of the planners that I spoke to believed in a enjoy life fund, where they say that you should keep aside this money, go in. A lot of them believe that this, goal-based planning is great, but give yourself a break also. Just keep aside some money where you feel that, okay, you need to take a foreign vacation every year or at the end or every second year, every third year. So goals can be whatever you decide. If you have covered your lifetime, whatever from foreseeable events, and you've narrowed them down to goals and you're investing towards that, honestly, there can be as many goals as you want. I mean, there are people who believe in children's marriage. There is postgrad for kids, so education for kids can just go on and on. And if you have 2 kids, then of course, it gets to be more than that. One interesting anecdote, I don't know who it was, I think it was Vishal. He shared with me was about this doctor. This doctor had his own nursing home. Okay. And he wanted to expand into a hospital. So he sat with these guys saying that, and these guys did their usual, Excel file and this and that. And then they said, listen, Excel mein to ye dikhta hai. Now let's leave this. Let's talk. What do you like to do? The guy said that I love passion. My passion is photography. I love to travel. So they were like, maybe you want to think, because the hospital is a full-time job, setting it up and all that. Do you really think, I mean, money-wise, we can give a plan for you. But do you honestly think that you are willing to let go of your passion, something that is your calling, that 2 months in a year, you just leave everything, you take to the jungle, you click photos and you come back, you'll have to let go of all that. And this guy actually changed his mind. So I'm just saying that the goals that you have might not be as comprehensive as you think. So just keep some space for that.
Right. In fact, it seems some of these advisors are kind of more life advisors also, right? Pointing you in the right direction. Anupam, then there are a couple of questions on how to think of financial planning at different stages of life. We've covered the young professionals, we've covered retired ones. So here the question is that concentration or risk. How do you view that? So somebody, Suruchi Mahajan, says that she's been investing in equities, mutual funds for quite a few years now. It's a sizable corpus now. So do you think at different stages of life, people should be thinking of where investments are, or is there any rebalancing that needs to be done, and how?
Yeah. Again, this is a consensus view across all the advisors, and it's just 2 words: asset allocation. That's it. Your asset allocation needs to reflect your life. That's it. At the age of 65, if 100% of your money is in equity, I don't think that's a great place to be in. Okay. This has to keep on changing at every life stage. And this is something that the advisors will easily hold your hand on. That at 25, it's something, at 35, 45, 65, everything is about asset allocation. And asset allocation has a much, much bigger role in returns than security selection. I think that there's enough academic literature also that says it, because I've read this in a lot of places, I think, including a lot of the Marcellus Sunday newsletters that come out. Everything is asset allocation. And people are still in that whole, that have I bought the right stock or the wrong stock and all that. And I'm like, listen, guys, it's, if you've broadly got your asset allocation right, then there are absolute rough benchmarks also. Salil, you would know this, but I think 100 minus age and all that kind of stuff. So the answer is yes, please keep checking your asset allocation at every life goal. Very important.
Right. Now here's a question from Dr. Sharmila Banwat, and there's an interesting one. She says that salaried people in India have a lot of ability. One is to save regularly. I think that's what she's meaning to say. At the same time, there is a better financial security because provident fund, pension, these are the options that they have. But for professionals or self-employed people, how should they think about financial planning, especially post-retirement?
Yeah, I think I should get Saurabh's view on this because he's someone who's actually transitioned, right? I mean, he's let go of his entire safety net, security net of a recurring salary and jumped into the world of entrepreneurship. Maybe he can come in with that. But no, she's right. The good doctor is right. And every time I've gone to my dentist, he keeps on throwing these questions at me, saying that, all this is great for salaried people, but what do professionals do? And honestly, there's no black and white answer for this. Salil, the one tip that I've got from the advisors is that save disproportionately when the going is good. I think that's one thing that typically seems to work, and be a little bit more conservative in your investing. Don't, put everything into equities. Just have a slightly more solid foundation that can take you through the ups and downs that come with a entrepreneurial or a professional life. Of course, there is absolutely no substitute to investing in yourself. Again, that's what we wrote in the Victory Project, that if you're good at doing something, and if you grow to that level, then hopefully the market will pay you that much. But leaving aside those fundamentals and sticking to the financial part, I think this is one tip that I got from all the advisors when it came to professionals, is that be a little bit more conservative and save more aggressively when the time, when you're actually, your profession is doing really well. And when you're, touch wood, I hope it never happens with any profession, but when the business is going down, then again, you'll have to be a little bit more ruthless with the expenses. That is honestly the only way that you'll be able to control your savings and commit to an investment plan. That commitment to an investment plan long term is really something that's very important. Saurabh, I don't know if you have any views on this.
I think Sharmila raises a very, very good question. But I also think that most people in private sector jobs, you are no more secure than a self-employed person like Dr. Banwat. So this notion that private sector job mein aapka employer aapke liye kuch kar dega, whether from a pension perspective or from a savings perspective, wo to hai nahi, zero hai. There's no employer-provided pension construct in our country if you're working at the private sector. You can do an NPS if you have a salaried job. You can do an NPS, a National Pension Scheme, if you're a self-employed professional. That's regardless. And for those of us who are not a public servant, if you are in the public sector, then the NPS construct is different. For the rest of us, whether it's a self-employed person like Dr. Manvat or a salaried person like whoever might be listening, the NPS construct is similar. And I used to do it when I was a salaried employee, and I continued with the NPS even after Marcellus was created. Distinct from NPS, I used to invest in the CCP construct. In my previous avatar, I invest in the CCP construct. In my current avatar, it's a demat account. It's a PMS is a demat account in quite simple terms, and it contains a bunch of stocks. And lastly, I would have term life cover, term insurance cover. Previous job, I bought extra term insurance cover when Marcellus was set up. I have medical cover, which I had before, I have now. And finally, the emergency fund that Anupam spoke about. So in practical terms, right, there is no difference, regardless of whether you have a job or you're self-employed. In practical terms, you got to do much the same things. From a financial security perspective and from a financial planning perspective, Viraj, rather than a reality in modern day India.
Right. That reminds me, my father-in-law is a doctor, and he and my wife keep having this banter where he says that you guys are lucky, you'll get a monthly salary and you'll get some retirement savings and all. And my wife says, I'll retire at 60, but as a doctor you can keep practicing till you're 75. So it's all the same. So I think that's always
unfortunately, my father-in-law didn't have that dialogue with me. A man called Mark Mobius opened my eyes to this subject 5 years ago. So I was discussing with Mark Mobius. This is pre-Marcellus. I asked Mark, what led you to quit Templeton and set up, your own shop, Mobius Capital Partners? So he said, I spent enough time to realize that working in a large firm, actually, there is no security. I said, how can you say that, Mark? You work in a giant construct, an MNC construct, salary aa raha hai, pension aa raha hai, sab kuch hai, sorted hai. And he gave a mind-blowing analogy, which always stays with me. He says, if you think you're in a large firm and you think you're climbing up a ladder, you're sort of getting promoted and appraisal ho raha hai aapka, in effect, what's happening is that ladder is plunging down in space, right? So the illusion of security that large firms create is just that, an illusion. Companies, large or small, Indian or American, are all competing in a hyper competitive global market, and therefore all of us, whether we are salaried or self-employed, we have to think about our financial futures. There is no MyBap who's going to sort it out for us, whether we work for an MNC or a Desi company or are self-employed.
Right. Okay. So, Anupam, moving on to the next question. This again is interesting, and this is on retirement planning, or more specifically, what is the corpus that one would need at retirement? It's so difficult to predict 25, 35 years out into the future. And these thumb rules, 25 times of your current salary or 50 times of your current salary. You never know what really is going to work. So, is there some way or some framework to think of how much do you really need for retirement?
I don't know about that, Salil. I mean, these mathematical frameworks are unfortunately the only material we have now. And honestly, just having a fairly large corpus which gives you recurring income is the only simple benchmark that there is out there. And Saurabh has written about this also a lot, that interest rates in India will just keep falling over a period of time. And you can't expect to have that 7-8% PPF and whatever that's there. It's not going to be there forever. At some point of time, you will have to, consider equities in whatever construct. Could be dividend paying companies, could be, solid companies like the coffee can, which at least, are generating that, whatever it is, 8, 10, 12% every year after year for a long period of time, that can help you prepare for that. But really, beyond the mathematical framework, I really can't. Again, this is based on whatever the advisors have told me, but there is, to understand for each person, each person's needs would be different. But this mathematical construct, unfortunately, is the only thing that we have now.
Sure. Right. Now, here there are again two questions, both related to real estate investing, right? One is from anonymous attendee, one is from Manish Maisheri. And this question is about leverage. So, if you've already been doing real estate investing and now you want to go on, think about financialization of savings, how should you think if there is an existing debt or loan that you have for a property? Is it all right to sell the property? It's a second house, presumably. You sell the property, retire the debt, and use any surplus to go and put it into equities, or let the debt stay. I mean, is that again emotional decision, or is it a financial decision?
This thankfully should be a financial decision, because it's a house that's for investment. Honestly, it is an investment. It's not an asset, and the purpose of an investment is to get a regular return each and every year on that. Now, if whoever this person is getting the market rate on this investment, I believe commercial real estate also has a reasonably good 7-8%, and if that fits into his goals and his risk return profile, taxation, liquidity, if that's fine, then honestly, if he's happy with it, then I can't see any reason for him to sell that and go into equities. Subject to, like I said, rate of return, liquidity, taxation. There are three very big boxes to tick out here. Personally, I've always felt, and again, I've got this from a lot of people that I know who are in the real estate business. A lot of them are actually going towards REITs, because they're saying that we are getting 5-6% transparent. It's a liquid instrument. It's out there. These are the best asset managers in the world, the embassies and the Brookfields. They prefer that over actually investing in real estate. But the question of debt and leverage, again, I'm conservative. I am not comfortable with having that much of debt on my books and keep on servicing it, given the way life is uncertain nowadays. To have lower debt and have it, and be in instruments that are transparent and liquid. And I think that only equities offers you that, is my own personal way of looking at it. Again, it's also what the RIs themselves believe in. But there are a lot of people that I know who are also comfortable in their real estate investment, provided it gives them that kind of rate of return that they want. Leverage, honestly, Salil, I don't want to answer that now, because it's a very tricky question. I don't have that kind of skill set. It's not a question that I've asked the RIs also. So I would avoid that.
Sure. Right. Anupam, couple of questions on advisors who are not professionally engaged, right? Which is, I think we already touched upon one where people are asking this young couple to buy a flat in Gurgaon. But there are many such, you can say, debates. So for a young investor, naturally the first advice comes from parents. And unfortunately for this gentleman here, it is the parents are advising him to buy gold, right? And then there is somebody here who says he's a CFP, a practicing CFP, and the clients just don't really get this goal-based financial planning. So, are there any any tricks or any ways for them to see the light, or maybe convince them to go about this?
I'll probably read Coffee Can Investing and Diamonds in the Dust. I think that would be one. No, there is no easy answer to this, Salil. There is really no easy answer. I think people who are convinced that they want gold, it's a bit difficult to wean them away from that. The only thing that you can offer to them is hard data, which I think even you guys have shown that gold has beaten equities over long periods of time. And it's a diversified asset. If you put in a mutual fund, or you put into an NPS, or you put in an index, you've got a transparent instrument that trades day in, day out. You've got liquidity. You've got a lot of things playing in your favor there. Gold is just one asset. And it's honestly, I don't think that you would want to put so much of your money into gold. Even the advisors that I've interviewed, at best, they said, even if anybody wants to, then please keep it limited to 10% of your portfolio. That's it.
Gold just to echo Anupam here. So in Diamonds in the Dust, the first chapter, we've shown that equities in India, taking equities as Nifty, say, the Nifty comprehensively outperforms gold over sensible time horizons. So you get a better return from the Nifty than from gold. So then the logic then becomes, well, should I invest in gold because is it less volatile than equities? And the answer is no. Nifty and gold have similar volatility. Gold gives you lower returns for the same amount of volatility as equities. And then the final sort of straw to cling on to, if you're a gold lover, the final straw is gold negatively correlated with equities? Does gold go up when equities go down? And again, the answer to that isn't true. Over long periods of time, gold and equities actually have a positive correlation. This analysis based on World Gold Council data is laid out in the opening chapter of Diamonds in the Dust. Just read it. It'll help you set your mind at rest and avoid imprudent purchases of the yellow metal.
Great. I think, Anupam, we are largely done with the questions. So thank you for answering all of them. Anything you want to leave the viewers with? Any last thoughts?
Goal-based planning, Salil. That's it. That's the only thing that I would say. I think that was the biggest learning for me in the about 1 year that I spent writing this book, talking to I don't know how many people out there, but all of them just said that we've all got very busy lives. India is a country that's, and Saurabh has also spoken about it, written about it. India is changing almost, by the day, and there are enough opportunities for everybody to make their careers into lucrative ones. And also, so focus on investing in yourself, improving your talents, and leave the money to the people who know what to do. If you're someone who doesn't want to hire an advisor, then please have a simple financial plan. Keep reviewing it often, set goals, invest accordingly, and that's it. You're pretty much sorted. This noise that you see with every bull market of, this stock, that stock, WhatsApp, blah, blah, please, you're better off spending time reading Saurabh's books than, watching Insta reels of these stupid influencers and all that. Sorry, I'm just,
So let's end on a positive note. Anupam Gupta says do goal-based, GOAL, goal-based financial planning, not gold-based, not GOLD based financial planning, goal-based financial planning kare. And Anupam, wishing you the best of luck with the
Thank you, Saurabh. Thank you.
May you write several lucid, fluent, readable, useful books like this in what I'm sure will be a long and distinguished writing career.
Thank you,
folks. Thank you for joining us on this Janmashtami evening. Bye-bye.
Thank you. Bye.
Thanks. Bye.